All right, let's get started. We've got heaps of people in here. So thank you everyone for coming. So what we're going to do, we're going to spend a little bit of time. Actually, I might share the presentation. Do we have that? All right, please just give me a yes. I can see the slide because I'm fantastic. Thank you, Lauren. Really appreciate it. So we're going to talk about borrowing money for your first home, and we're going to talk about personal insurance. So myself, I'm Phil Thompson, the director and financial advisor at Skye Wealth. So what we do is we only do insurance advice. So we're financial advisors, and we just specialize in personal insurance advice. And Cait is the director and amazing finance broker at Zella, who has many years experience working with first home buyers. And so going to share kind of your experience. So thanks for joining me, Cait. Don't know if I said that before.
Thanks,
but
Phil. Although I didn't pay Phil to say that. I just want everyone to know.
No, you didn't. And I think that's Victoria in the comments who said she was going to be a pest, which is good.
Serial pest has arrived. She's going to learn what I actually do. Thanks, V. I'm really glad I did pay Phil to say that. All right. Well, everyone ignore Victoria's comments.
All right. So we'll just start off with a disclaimer. So everything we talk about is all general information. Please don't go ahead, action anything, and come back and point to this webinar and blame us for it. So that's a general advice disclaimer. So the agenda for tonight. So it is an hour session. We're going to do a lot of Q&A. I'm going to spend a lot of time on Q&As because we find that gives the most value for people who've got questions, and we can kind of try and provide as much value as possible. So we're going to go through and probably spend like 15-20 minutes each talking about home loans and personal insurance, and spend a lot of time on the Q&A. So feel free to just write as many questions as you can. Yeah, that's kind of the agenda for tonight. If it does go past 9 o'clock and you need to leave, that's totally fine. You can just leave. There will be a recording of the full thing as well. And Cait, you can't leave. You've got to stay around.
Okay. Right. Yeah.
And so to kick us off, go, Cait. You kick us off with welcome to country.
Perfect. So I would like to begin today by acknowledging the traditional custodians of this land on which we gather today, the Bunurong people of the Kulin Nation, and recognise their ongoing connection to the land, waters, and community. We pay our respects to the first Australians and their elders past, present, and emerging. Also, I do not look like that. That is offensive. And I think that photo is heavily edited, but that's fine. So let's start off with home loans. Thanks for letting me go first, Phil. That was very trusting of you. So I wanted to start the presentation, and yes, I prepared my slides in advance. I didn't leave them to 47 seconds ago like Phil did. Where do we even begin when we buy our first home? So this is something that I hear a lot is, people just don't even know where to start. They don't know how it works with going, for a home loan, or who to speak to, or what kind of things to have in place already. So I even use the example, I think I was like 20 and I was talking to my mom, knew I wanted to buy kind of my first home, and I didn't even really understand what a mortgage was. So we're really big on always telling clients, like, we're here to literally hold your hand, because there is no such thing as a stupid question. I've probably asked way more stupid than anyone has ever asked me when I first kind of started my journey. So one thing we say is that if somebody has a goal to buy a home, to go and speak to a broker, because this goal, you don't know kind of what you need to have saved, or if you need any savings, or how much it needs to be, or how much you can borrow, and all of these kind of technical terms that come into play when we look at buying our first home. Now, don't get me wrong, it's good to have as much savings as possible behind you, because, who doesn't want as much savings as possible? But what's really important, and I use this example a lot, if you're aiming to buy your first home and you think, okay, I want to go buy my first home and I'm aiming to buy for $600,000, and I've heard out there somewhere that I can buy with, it might be a 5% deposit. If you don't actually know how much you can borrow, it might be great you have this goal to buy your first home, and we really encourage that. But going and speaking to a broker will really help set those foundations to figure out, am I actually in a position to even be able to borrow enough to buy my first home? How much do I actually need as a deposit for my particular situation? because there's, it's good to have that goal to go and buy your first home, but to have these foundations and to be able to set these targets and know exactly what you're aiming for can be a really good starting point when it comes to wanting to buy your first home. Now, if you're sitting here listening and you're not even thinking of buying your first home for 5 years, or you think it's 10 years away, I had an hour power session the other day actually with some clients, and their goal was to buy a house in 5 years. We did the hour power session and they learned what a guarantor loan was. They learned that their parents would be happy to do this. All these terms that, people listening probably have never heard of. And now we're doing pre-approval and they're going to aim to buy a home in 3 months. And they just didn't even realize it was possible. So very first thing, go and speak to a broker, because that is their job, to coach you and guide you on how your situation looks now, or how to get yourself in a position to be able to buy your first home.
Hey, Cait, I know I said I wasn't going to jump in and interrupt with questions, but what happens if people feel kind of bad? Like, if they think they're 5 years away, they don't want to waste people's time. Like, how do you guys feel about that?
See, I think this is a thing though, like getting a broker that's on your team. So if you go and reach out to somebody and they turn you away, then they're probably not the broker for you, because there's going to be people out there. So for us personally, we do have a service, which is our Power service. And that is designed to take the time to help people that might be, that 5 years plus away. I guess just to comment on that, brokers are paid by like a loan settling. So yes, I understand, brokers, whatever, are going to want to be compensated for their time, but there is definitely people out there like us who are willing to sit down, coach people, help people, and set them up, because it's kind of one of those things where I think it's invaluable to know what your position needs to look like, instead of kind of knowing you want to achieve something but you don't even really know how. So there's people that definitely do.
That's perfect. And literally we're 3 minutes in and I threw you off your slide. So
yeah, no. Yeah, you should be. Yeah, thanks so much. So one of the first things then we want to talk about. So your first step, go and speak to a broker, figure out what your position looks like and what you need to do to be in a position to buy your first home. Now, one of the things that comes into play with then buying your first home is considering what options are obviously available to you. Now, there are a lot of schemes that are out there, and you've probably heard some on the news, read some articles, whatever it is. Some of them, I'm going to be honest, I don't love, and other ones are some of the best schemes that have kind of been released that we've put hundreds and hundreds of clients through, because they're generally very good, for their position. So I'm going to speak about the main one, which is the First Home Guarantee Scheme. So you might hear it, it's called the FHGS, First Home Guarantee Scheme. This is where eligible first home buyers that have as little as a 5% deposit might be able to get into the market to buy their first home. Now, a lot of people that are buying their first home hear the term that you have to have a 20% deposit to be able to get into the market. That is just simply not the case in majority of situations. Yes, there's some where you might have to, but often you can get in with a much smaller deposit. Now, this particular scheme, to be eligible, and there's obviously an eligibility criteria, but the main ones are you do have to be an Australian citizen for this scheme. If you're a single, you have to have earned under $125,000 in the previous financial year. If you're a couple, it has to be under $200,000 combined in the previous financial year. You have to, there's certain prices that you have to buy under. So there's actually a link. And even if you just Google First Home Guarantee postcode lookup tool, hope someone took a note of that, because that was a mouthful. Yeah, just not a fill. Make me feel like someone did. If you search in that, you can actually put the suburbs you're looking at buying in, and this tool will say to you, okay, in this particular suburb, you can't buy a house that's worth more than 700,000 or 900,000 or whatever the amount is. So that is one thing you have to stick to. So yeah, there's certain eligibility criteria we have to make sure of. The best thing about this scheme though is that you can purchase with as little as a 5% deposit. So you have to imagine if you're going to buy, for $600,000, if you have $30,000 and that is that 5%, it needs to be what's called genuine savings. Now, genuine savings is money that has sat in your account and built up over time, generally more than 3 months. Now, it has to be 5% genuine savings. There's always going to be some purchasing costs, which we'll get to as well. Then you might be able to buy, that home for $600,000. Usually if you purchase, and let me know in the comments if this is going to confuse anyone. Usually if you purchase with less than a 20% deposit, you cop something called lender's mortgage insurance. Now, lender's mortgage insurance is basically a fee that the bank take out to protect themselves, and they charge you that. So they add it onto your loan. You can pay it up front, but I've never seen that. They add it onto your loan. It's thousands of dollars most of the time, and they go, hey, you've got less than a 20% deposit. You're high risk. I'm going to charge you this fee, and I'm going to add it onto your loan. The beauty of the scheme is that cost is waived, even though you're only contributing 5%. So in some cases, it might be saving people, $20,000, $25,000, a massive saving. And it's all because the government are basically wiping this LMI, so lender's mortgage insurance. So not only are you saving on this massive cost just because of this scheme, you also get access to interest rates as if you have contributed a 20% deposit, even though you didn't. So it's not just upfront contribute less money to be able to get into the market. It's that you're actually getting an interest rate that is much more competitive and affordable upfront, and then obviously over, a longer period of your loan as well. So first home guarantee scheme generally is a very, very, very good scheme. Like I said, we put hundreds of clients in it. The scheme is it's Australia-wide, so it's in every state. Now, how it worked was there was 35,000 places, I think, released July 1st last year. It is a first in best dressed. There's particular banks that are a part of the scheme. Now, that's a broker's job. So our job is to figure out your situation, which bank out of the ones that are a part of the scheme are going to be most suitable, who has the most competitive rates, what's the best loan structure. All these things are really important still. But yeah, there's certain banks a part of it. It's Australia-wide, doesn't matter what state that you're in. It's first in best dress though, but there's still places available, and they're releasing more places come July 1st in a few months. So we're still expecting kind of that larger rollout. And it is definitely, like I said, one of my favorite schemes. That is the first home guarantee scheme. There is another scheme that's in play. I know this is a first home buyer seminar, but I think this one is really important, so I wanted to touch on it quickly. There is also a single parent scheme. Now, the single parent scheme, you don't actually have to be a first home buyer, which I love. So the idea is to try and help single parents stay in or get into the property market. The difference between this one, though, is you can purchase with as little as a 2% deposit and have no lender's mortgage insurance added to your loan, have competitive interest rates, all of the similar things to that first home guarantee scheme. There are obviously certain criteria again. So property prices, income has to be under 128,000. As a single, your child has to be a certain age, blah, blah, blah. But this scheme as well, basically the same banks that are a part of the first home guarantee scheme are also a part of it for the single parent scheme. So if you're a first home buyer, I guess, listening to this, and you're also a single parent and you're like, oh my God, I have more than 2%, but maybe not quite the 5% or whatever it is, then that's also worth having a discussion. And it's your broker's job, obviously, to make sure you're not scraping every cent together and getting left with nothing. That would obviously be very irresponsible. But it's more about being aware of these schemes, again, to go, oh, I only need this much. Great. I'm going to aim to save this up. I can borrow this much. I'm going to aim to have X amount left over as my emergency fund. Vicky D, you'll be proud of me for mentioning an emergency fund. And yeah, so that single parent scheme is also amazing. There is then also the home buyer fund. The home buyer fund isn't my favorite. I'm going to be honest. It's not my favorite. And that's not, brokers can't actually write loans in the home buyer fund. I think there's 2 participating banks in the home buyer fund. I don't not love this because I'm a broker and can't write the scheme, just to put that out there. This fund though, if somebody is going to go into it, and we can lay out on the table going through the home buyer fund or going through the first home guarantee scheme, I'm going to argue that 99.9% of the time, the first home guarantee scheme is going to be more favorable. The reason being, through the home buyer fund, the government physically own a portion of your home. So usually it's 25%. They put in basically some money to be able to help you buy your home, which also, please don't get me wrong, this might help people get into the market and that really suits them. I just want to clarify that. But if we're comparing the two, then it's definitely a favorite. The home buy fund, the government physically own a portion of your home. If your property goes up in value and if the government still own that portion, their portion that they put in also goes up. So they're making money as your house increases, and it's just a little bit debatable whether, that necessarily suits everyone or there's better options out there. So if somebody is looking at the home buyer fund, again, some people have to go through that one. It might be for borrowing reasons, it might be deposit reasons, things like that. But definitely don't get the two confused, which is why I've got that one on there. I will preface this, I'm definitely not an expert with the home buyer fund. We don't obviously, can't put people through it. It's just from everything that I've read. There are other rules around it. I think they're still in play. Things like if you want to renovate your home over a certain amount, you have to get approval to do so. If you want to refinance to move to a different bank, you have to get approval to do so. So there's all these things that you kind of have restrictions if you go through the home buyer fund, which is the government owned one. Not so much. There's still restrictions, but not so much through the first home guarantee scheme. Did everyone keep up with all of that? Phil, thanks, Phil. There are other schemes that you probably might have heard. Thank you. You might have heard throughout different states. And again, that's something that we always say, if you've heard of something, it could be that because of the particular industry you're in, you might have access to a particular scheme, things like that. They're ones that we look into when we're having that meeting and go away and do that research because it might be very specific to you. Thanks, Lauren. How much do I need to buy my first home? So I briefly touched on this just before in terms of if you are going through a scheme, then that first home guarantee scheme, we look at how much you can borrow and we look at obviously how much you need as a deposit. That is where you may be able to purchase with as little as a 5% deposit. Now, there are still fees involved, which we love. No one gets my sarcasm yet. When we buy our first home. Now, for example, again, it depends on state to state. In Victoria, if you buy a home that's $600,000 or less, you don't have to pay something called stamp duty. Now, it's a fee, goes to the state rev government. We love it. The fee normally for $600,000, you'd be looking at about 30 grand. This is waived because you're a first home buyer here in Vic. For South Australia, for example, apparently you're not loved as much and you have to pay stamp duty in full depending on no matter what your purchase price is. So sorry to tell you about that. But then things like New South Wales, Western Australia, all these other states, they have got stamp duty exempt up to a certain price. So stamp duty is something that may or may not have to be added onto your loan. Outside of stamp duty, it's really important we're still allowing for other costs. So we've got in this example, we've got our 5% deposit because we can go through the scheme. The other cost that we need to allow for is a conveyancer. So a conveyancer does all of the legal side. They, if you want to buy that house down the road, they make sure that that goes into your name. They're helping you check contracts, make sure you're not getting into any not nice situations, I guess. That's their job to help you with. And they are way more important than I think people always realize. So you'll often find that in your little bestie squad, I call it, my professional term, you'll have your broker that's doing all the finance side and you've got your conveyancer doing all of the legal side. And we are your two best friends throughout this process. So don't stinge out on a conveyancer because they are very important to making sure you actually get the home as well. So we've got a conveyancer. We have obviously maybe a stamp duty, but ignoring that one for now. The other fees that we're always going to have are some council fees. So it might be, I buy a house that somebody has already paid a year's worth of rates and I buy that house a month into the 12 months, I am going to be paying them back for the difference. So the remaining 11 months, there might be some other council fees that come into play. How much the council fees are, you won't actually know until a few days before you're going to settle. So settle is when you own the home. Now, we will always allow a buffer, but it could be $100, could be $2.5 grand, could be $3 grand. So again, depending on the situation, we'll always advise your conveyancer will be a little best friend to tell you exactly how much you will need for that as well. On top of that, you always have like other government fees. To be honest, they're all government fees by the sound of it. So you'll have some mortgage fees, some transfer fees, and so on. As an example for Victoria, if you're going to buy for $600,000, you don't have stamp duty. Therefore, the fees I would allow roughly for a purchase of $600,000 would be about $6 to $6.5 grand. So it's a really good example. If you've got your 5%, which is your $30,000, you've got your six-ish grand for fees. And if you're sitting, listening to this, you're like, oh, I have more than that. I've got like 50 grand or whatever it is, then great. If you're not quite at that, you can use this as a rough target, obviously, for things to work towards banking on this scheme. Again, if you've got stamp duty, obviously an added cost that we have to allow for. So we've got our deposit. There are other things like a guarantor loan. So a guarantor loan is when you're using usually a parent, and I'll go through these if people are interested in this. So with guarantor loans, you usually don't actually need a deposit if you don't want one. So having a guarantor, which is a parent, we take into consideration their security, so their house, and it probably gets a little bit more complex, but we look at things like equity. So equity is the difference between what their mortgage is and their house is worth. So for example, if your mortgage is $200,000, your house is worth $400,000, that's $200,000 worth of equity. If your parent's home, for example, has your usual 20% I mentioned we need over here normally, but they've got that 20% in equity in their home, you might be able to purchase with literally no savings, which is something we can talk about to make sure it actually suits you, but no savings because your parents are going to put up that equity. It's not physically handing the cash over or anything to allow you and help you to buy your first home. So you still need to be able to borrow enough. There's still some fees you're going to be out of pocket for things like that. But technically, if you have the guarantor option, you might not need a deposit at all. So definitely something I can get into more if people are interested in it. Yes, I'm just going to answer that question because I saw it. Your guarantor can be retired, actually. So there are some banks that will consider a guarantor, so a parent, even if they aren't currently working, because they're just looking at the equity in the home. They're basically saying, hey, you need a $100,000 deposit for your usual 20%. You don't have that $100,000, but your parents' property, mum or dad or both, have $100,000 sitting in it in equity. We're going to lend to you what you need, but if you stop making the repayments on that home loan and you can't pay us back what you owe us, that's where the bank have the right to come after the parents and say, hey, you promised us this $100,000 if anything went wrong. Either basically give it to us or they could force the parents to sell the home to give it to them. So it is a big risk. You do have to get with most banks independent legal advice now, which sounds a bit scary, but it is just to protect them, make sure they understand the risks. But again, we do guarantor loans literally daily. Like for some parents, they love the idea of their, kids getting into the market that way. Some people don't have that option, but it's good to know for this example that to buy your first home, you might technically not need a deposit. Thanks, Phil. I'm just going to pretend that you're still interested. This is an example if you, Victoria, if you're judging the graphics for this, I wrote out an email with like all the notes, and it's just, Victoria's like so perfect with her graphic design. So she's probably sitting there judging us. I wrote out this example. This was to purchase at $750,000. If you weren't eligible for the scheme, so if people are sitting here, they're not an Australian citizen, whatever it might be, the two things we always want to look at when you come to buy your first home is how much can you borrow and how much do you need in savings to go towards that purchase. And we need those two things to marry up nicely. Graphic design is my passion. The serial pest is back. Okay, so in terms of, I don't know what I was saying. Thanks, Victoria. I said I wouldn't read the comments. So we're looking at borrowing, we're looking at savings. This is an example if you aren't eligible for the scheme and you aren't, any of those schemes I've mentioned before, and you don't have the option of a guarantor, which is totally fine, not everyone does, and you're going to purchase, what it would look like in terms of the minimum deposit you would need and the fees that are going to be associated to this purchase. So this example, you're purchasing for $750,000. This might confuse some people, but the max loan we can go up to is 95% of the purchase price, including LMI. That is the comment that usually throws people. You might look at 95%, oh, that's still 5% deposit. It is not, because as you can see further down in the example, we have to allow for that LMI, so that lender's mortgage insurance, which is $31,000 in this example, if you were to contribute the minimum deposit. So when we then add basically together your LMI, your loan amount, that brings us up to 95% of the purchase price, which is why, because we have to allow for this LMI, you have to come up with a much larger deposit. You can't just do 5%. And the LMI is hefty in this example if you were doing your minimum deposit. So $31,000, no, you don't have to add it to the loan. I have never actually seen someone pay it up front, because usually you don't have the money to pay it up front because you're trying to get into the market and have to contribute as much as you can. So in this example, if you want to buy for $750, the minimum deposit you need is therefore $70,000. LMI of 31 roughly gets added to the loan. And obviously for fees, this is dependent on the state. Again, I've used this example from Victoria. If others need it in other states, let me know. But again, stamp duty in Victoria waived under a purchase price of $600. If your purchase price is $750 plus, you do not get any waivers for stamp duty. So you're paying the full stamp duty cost. And so in this case, when we add together the stamp duty and we add together those $7,000 purchasing fees, that's what's brought us up to this figure of $47,000 for fees. So we suddenly have to find, because we can't be eligible for the scheme, the $70,000 plus our $47,000 as a minimum to be able to get into the market to buy for $750. So again, we still want to make sure you can borrow enough. If you can only borrow $400,000 and you want to buy for $750, it doesn't just mean you can only come up with this minimum. You obviously then physically need to come up with a difference. Hence why it's important to still speak to a broker to figure out kind of where you're at and what path you can go down and what you're eligible for. But that is an example for purchasing for $750. This is an example. If you were going to do the 5% through a scheme, as you can see, it is much less. So we've dropped that deposit from 70,000 down to 37.5. Do I need pre-approval? Thanks for asking, Phil. I'll answer that one. Look, I do. It depends on the state, in my opinion. I literally just read that slide out loud. It does actually depend on the state, in my opinion, though. So when we come to buy our first home, in most states, except for New South Wales, thank you so much, New South Wales, we can place an offer subject to finance. So basically you're saying, hey, we want to buy this house. It's subject to me getting finance, though. If I don't get finance, I'm not going to lose my deposit. I will preface that you need to make sure the contract of sale doesn't have any counter clauses to that, blah, blah, blah. That is where your conveyance is your best friend. If you are going to an auction, though, it is what's called an unconditional purchase. So unconditional means you are literally purchasing with no conditions. So if you cannot get your finance approved, if your situation changed or whatever it might be, and you've put a deposit on the table, say bye to your deposit. It's gone, which is very scary. So if you're going to an auction, definitely you need pre-approval. If you are not going to auctions and you're very confident of that, can depend sometimes if you're close to the city, things like that, and you can offer subject to finance, you've had your situation looked over by a broker, you may not need pre-approval, except for New South Wales. New South Wales do this thing, instead of 99% of the time where you can offer subject to finance, they don't do that. They do a cooling off period instead, which is where you still, if you don't get your finance, will lose some money. It sucks, I'm going to be honest, because not everyone, you might suddenly find a place, but you're in New South Wales, and I am very conservative, so I would rather people not take risk with their money that they've spent forever saving. But in New South Wales, they have a cooling off period. It's usually 5 days to 10 days, which means that if you can't get your finance in that period, yes, you can pull out, but you're still losing some money. In most other states like Victoria, it's subject to finance for 14 days. Queensland, I think, is 21 days, blah, blah, blah. So other states are much nicer. New South Wales, definitely. So if you're listening to this, remember that. It's very important. The pre-approval process. Also, I'm nearly done with my slides if anyone's getting sick of hearing me. The pre-approval process. Speak to a broker. You guys will notice as well, and we're very big on this here at Zella, I'm so supportive of brokers. I have friends that work in banks, so please, if you're a banker listening to this, I still love you. But I will say, and even if I wasn't a broker, I would say this, brokers' jobs are literally to go and do the research to see which bank is most suitable for you. So there might be banks that aren't as lenient with self-employed income or casual income, or can get you a much lower rate, or have a better loan structure, all these things you wouldn't think of. And just because you've banked with a bank forever doesn't mean they're the best for you. And I cannot stress that enough, because we have a lot of clients that come to us after going direct to a bank going, save me, like they haven't looked after me, my rate's really high, I don't think it was the best thing for me. And then, we do that holistic research to see who actually is the most suitable, and having access. I think most brokers have access to like over 40 or 50 lenders. You have to imagine that that's literally our expertise. And I often say this, that even for some reason, if you're not going to come to us, which I hope you do. Go and speak to a broker because, like I said, this is literally their job and we're so passionate about that. Anyway, so speak to a broker is the first part. They are going to then go and do all of the research. They're going to educate you, go through your scenario, go through the situation, figure out what, things we need to be aware of or what we can note for you that's important that might not be the same for somebody else. And we're going to go and do that research for you. There's usually, I'm going to argue 3 or 4 banks that stands out for most client situations. But once we actually break it down and we go through the structure and we go through the rates and any fees and the likelihood of it being approved and all these extra things, there's always usually 1 or 2 that stand out. So broker's job, do the research, come back to you and explain all of that. We then finalize which bank we're going to go with and make sure obviously you understand and agree fully. And that's when we start the application stage. So look, some people think that banks ask for kidneys to be able to get a loan approved. I do semi-agree with that. They seem to ask for a lot depending on your situation. It's for good reason. It is obviously to make sure you're not putting yourself in a compromising financial position and that you're going to be, able to afford this loan. But be prepared for the paperwork side of things and then obviously just signing forms. And then it's a matter of obviously lodging the application to the bank. Now, people often ask, how long does this process take? Honestly, some of our research, obviously we do this every day, so keep that in mind. It might take us a day, it might take us 3 days. It depends on how complex the scenario is. Lodging the application and processing it. There's a lot more admin that is behind the scenes, and I think people realize if there's any other brokers listening to this, they're probably going to be nodding, agreeing. So there's a lot of admin we do, but say it usually takes a day or 2, and then it's actually lodging it off to the bank. Now, how long that takes depends on a bank's turnaround times, and this might come into play which bank is most suitable. So some banks' turnaround times might literally be 2 hours, other banks might be 3 weeks. So there's some banks at the moment that are literally at 4 weeks to pick up a pre-approval application to even assess it. And we might have that conversation with the client to go, look, this bank is most suitable in terms of the rate. But if you'll want to go to an auction in 2 weeks, then it might be really unlikely it's going to get picked up. Obviously, brokers do whatever they can to get it escalated, things like that. There's some tricks we have up our sleeve, but these things come into play. So how long that takes depends on the bank's turnaround times. We then get that pre-approval, and on that pre-approval, and this is really important, I shouldn't point this out by talking with my hands all the time. I regret saying that. I'm going to sit on them now. When we get pre-approval for a client, the pre-approval is always subject to evaluation. Now, what that means is we've had the bank look at your situation and say, we're happy with how much they can borrow based on their income. We're happy with their credit scores, any debts they've got, things like that. But they still don't know the exact property you're going to end up buying. And believe it or not, there are some banks that don't lend to certain postcodes or certain apartment sizes or, whatever it is. These are really important. So we always say, even though you've got pre-approval, it's always subject to evaluation. It could be that, and we've seen this happen, that somebody's gone to an auction, they've bidded way more than what the property is actually worth in the market. Evaluation's been done and it's come back short. And in that case, the only way really is the client has to come up with the money. Now, you're not going to know that. You think, great, I've got pre-approval, I'm good to go, I can go and buy anything. Really make sure you understand the terms that come with your pre-approval because it can differ per person, and we're very big on that education piece as well. So once you've got that, you understand it all. That is the best part though, where you can go house shopping. So we always say to clients, if they're going to put an offer in, send us the link to the property first. Let us look the best we can and see if we can see any red flags. Sometimes obviously we're not the valuer, we're not to know. But again, you have to have a broker that holds your hand this whole way because that is the importance. And that could be the difference between you think you're fine, but the valuation doesn't stack up. I already went through that. Sorry, Phil. Oh gosh. That is obviously the basics of my talk. I know there's a lot of questions that have come through, so definitely will answer a lot of those at the end, but hopefully that's given people somewhat of a 101 on buying their first home.
That was fantastic. I wrote down stuff and I learned plenty. And for me, some of my takeaways from your talk was that experience is key. Getting people in your corner who know about the schemes and the bonuses and what's available to you. And as you're saying, broker or banker. One thing, as you said, not all banks are party to a lot of these schemes. So if you go to a bank and you walk down to your local bank who you've been banking with for years and years and years, the people who are going to help you set up the loan, they may not know these schemes because their bank's not involved in it. So that's why it's great working with a broker, number one, and working with people who are experienced, because these things change all the time. All these things that I, as a financial advisor, we only do insurance. We've only done insurance for quite a few years. So all these schemes and stuff, I'm just like, these are all pretty fresh and pretty new, and you've got to be on top of it as a broker. And don't go to your financial advisor who knows nothing about loans and ask them their opinion. Don't go to your accountant who may have set up their own home loan 5 years ago and ask them, what's the best option. You're probably going to have no clue. That was really good. All right.
Thanks,
I'm going to spend 3 minutes talking about personal insurance. So we're going to hit up all these questions as well. I'm certain we're not going to get all the time to answer every question, so apologies for that. But I'm going to talk about personal insurance, what it is, what are the different types of policies. So, as advisors, that's what we do. We help people set up personal insurance. And I'll just touch on the different types, so we're just clear on what insurance we're talking about. So there's really 5 policies that we help people with. It's not home and contents. It's not lender's mortgage insurance, even though that will, the insurance word's there. We help people with life or death insurance. So if you pass away, there's a lump sum payment that gets paid out. Second one is total permanent disability, or TPD. So if you look at your super statement, you'll see, TPD. And that means if you are totally and permanently disabled and you're never able to return to work again, then there's a lump sum payment that gets paid out. The third one is income protection. So that pays out a monthly payment if you're unable to work because of a health issue. So you're injured, ill, sick, unable to work because of a mental health condition, then you'll get paid out a monthly benefit until you're ready to return to work. Now, there are some nuances with those policies, like there are like waiting periods. How long do you need to wait before you can get paid out is depending on the contract. So you can wait either 30 days or 90 days, or some contracts you have to wait 2 years before you start getting paid. And then the second thing is like, how long will you get paid for? So that's called the benefit period. So a lot of like default covers will just be like a 2-year benefit period. So they'll pay you every month, but just for 2 years, and then it'll cut off. So if you need it for longer than that, then too bad. The policy doesn't cover it. And then you can have the policy income protection last till age 65. So you can get paid every month if you can't ever return to work until age 65. The fourth cover is trauma insurance. So that's for specific medical events. So the majority of claims, or the biggest event in a trauma contract is cancer. So if you have cancer, then you get paid out a lump sum. Whatever benefit amount that you're paying for, you'll get paid out on. And the last one is child's cover. So it's not talked about. It's not that fun to talk about either. But if something happens to your little ones, something really significant and serious happens, there's a lump sum payment that gets paid out. I had child cover for my eldest, and then my next 2 came along, and I forgot to add it, and then they were like 6 and 7, and then I was like, oh, actually we've got to make sure they're covered as well. So all of these policies are really important, and that's what we talk about personal insurance. We don't talk about car insurance, home and contents. That's not what we do as financial advisors. So there's kind of 3 ways to get these policies. So the first one is through what's called group cover. So if you join a group that has an insurance policy, and the main groups that have insurance policies like this is either a workplace. So you may have a workplace cover. Normally it's income protection that they'll set up. And so once you join that group, you can be covered by that income protection policy. As soon as you leave that group and you leave that workplace, you can't take that policy with you. The second kind of group is superannuation funds, and that's the most common one. So when you join a super fund and you're joining that group, you can be covered under that insurance policy, and that insurance policy is set up between the super fund and the insurance company. And so again, if you move super funds and you leave that group, well, then you're no longer covered and you can't take that policy with you. The second way to do it is direct, either directly through an intermediary or through the insurance company directly. So when I talk about intermediaries, I kind of talk about like, Amy Insurance or Real Insurance. So they're kind of predominantly like you're doing it online, direct with the insurance company. Most insurance companies don't actually offer direct cover. There's only a handful that do, and yeah, it's the quality of the policy is not that good. The flexibility it's really inflexible in terms of the way you have to pay it. If you go direct, normally you can only pay it direct to the insurance provider. You can't pay that through your super fund, or you can't structure it in more tax effective ways. And the third way, which obviously I like because this is what we do and this is what we're passionate about, is what's called retail cover, set up through a financial advisor. And so it just means that we can set up policies where your super fund pays for the premium with whatever insurance company that we think best suits you. So similar to like the mortgage broking, we go and do a lot of the research. We partner that insurance provider with yourself, predominantly based off your health history and kind of the premiums that they're charging. The benefit of an advisor is there's majority a lot more flexibility. There's a lot more options. Through the group cover, you don't get child cover or trauma cover, and some direct insurers, they don't even offer like total permanent disability. So it is much more restrictive. So, why is it important? So, getting insurance when you're young and you're healthy is the best time to do it. So people think, well, I don't need it because I'm quite young, nothing's going to happen to me, but it's actually the best time to do it pre any health condition. So the reason being is because when you apply for cover and you do it well, they're going to ask about your health history. So similar to getting a home loan, you've got to go through a whole bunch of paperwork to prove that you can afford this massive mortgage. Same when you get insurance. You got to go through a lot of paperwork to prove that, you're worth insuring, basically. Now I get really distracted when someone puts up that question, but, I heard insurance is tax deductible. I'll answer that later because it just went off my screen. And then the other thing is, at the end of the day, your ability to go to work is what's going to pay for this mortgage that you're going to get. So if you can't go to work for health reasons, then you're not going to be able to fund the mortgage. Now, there are things like redundancies that, will make it difficult to fund it. But it's really the health issues that have a long-term impact on your ability to work. And also when you're young and you're buying property, the lifetime value of your income is astronomical. People, kind of underestimate, if you're 25, you're earning 85 grand a year, which is, good on you. Well done. That's a big income. Your lifetime value of your income, assuming you don't get any promotions, is worth like $8.4 million. And so the value of yourself and your body and your brain is extremely important when you're young. When you're old and getting frail like me, Cait calls me old all the time. And we've got a landline phone number for our business, and Cait teased me about it today. But when you're older, you're getting closer to retirement, the lifetime, even though your income may be higher, the lifetime value of that income until retirement is significantly lower. So that's why getting insurance when you're young, you're healthy is really important. Now, one thing, I'm going to kind of skip over this pretty quickly, just out of interest of time, but I always think about insurance as like, a matrix between the likelihood of an event happening and the financial impact of that event. So, things on the bottom left quadrant, it's very unlikely to happen, and the financial impact is quite low. So when it comes to like death insurance or life insurance, the likelihood of it happening when you're young is really low. You're pre-home loan, you're pre-dependent. So it means that the financial impact's actually not that huge. Like obviously everyone's going to miss you. It's super impactful from an emotional point of view, someone passing away. But from a financial point of view, if you don't have dependents, you don't have debt, then it's less important. The other insurances are important because they're either higher likelihood of happening or it's a really significant financial impact. So like disability is the most impactful financially. If you're disabled, especially when you're young, financially completely ruined and you're stuffed. Things like an income protection claim that only lasts for 6 months was more likely to happen than being totally disabled, but the financial impact is less. And the things up the top right quadrant is just, high likelihood of happening, high financial impact. Insurance companies are just not going to cover that. But when you get a home loan, so post-home loan, that life insurance cover actually increases in terms of the financial impact. So if you do have a partner and you've bought a house together, then or your partner passes away or you pass away, it will have a much bigger financial impact on your life. And then the next thing is, post-home loan, post-dependence, then there's a much more significant financial impact on that life insurance cover. And again, over time, these kind of, dots, they kind of move over time. So like something like a cancer event, as you get older, the likelihood gets significantly higher. And the other thing I wanted to kind of, raise is also just like insurance overall. Where there's so many insurance policies, everyone's sick of insurance because it's just a bill that hopefully we never use. Things like home insurance, contents insurance, pet, car, phone insurance, I've kind of mapped it in this kind of matrix as well. So, cracking your phone screen, I mean, I love my wife, Cait. Every year she cracks the phone screen, every single year. Now, we don't have insurance for it, but it's a high likelihood of happening. Car insurance, so crashing your car, depending on the driver, I've crashed my car twice in the last 10 years. So it's a higher likelihood of happening than being on income protection. Pet insurance, statistically speaking, is less common than cancer, requiring pet insurance. The amount of times that people go to a vet under events that are insurable under pet insurance is less common than cancer in Australia. But a lot of pet owners have pet insurance. Home insurance, there are things like we had a busted pipe. I've been paying home insurance for years and we only just claimed on it once. And it's probably going to cost us $5,000. So that's a small financial impact. But if the house burns down, then it's a massive financial impact. And contents insurance, I've never once claimed on it. We pay for it. And again, it's really for the significantly low likelihood of the house burning down that I'm really going to claim on it. And so that I kind of put it all together in the other policies as well, just to kind of give a frame of reference of going, at the end of the day, home insurance is, you have to have it if you're getting a home loan. You can't not get it because the bank owns that property. So you need to have that home insurance. But thinking about these other personal insurances are really important as well. So determining the right level of cover. Now, I've seen a few questions before we did this webinar. We asked questions about the level of cover. Now, I'm not going to tell you how much cover you should have. I'm not going to give you like a calculator for it because it is really personal. It's based on your personal situation. Definitely go and see a financial advisor to kind of get a good sense of how much cover you need. The way we think about it at Skye, and our philosophy is we want to leave people in the same financial position as if nothing happened. And so just kind of my very crass drawing of what this looks like is, pre-disability, we're going along this brown line financially, we're kind of increasing our wealth, we're building up assets, and then, a medical event happens. And the way we think about it is that purple line. So we want that trajectory of your wealth to be the same. And the most important thing about that is your income. If we can replace your income, that's significantly important to us. Now, if you want to save on premiums and you want your financial situation to kind of stay as it is at the time of the medical event, then we save on premiums and you reduce the level of cover. And if you want to, pay more and become significantly better off financially, like I personally have my cover, then you pay a higher premium for that. But the way we think about it is just think about try and replace your income if something was to happen. And then common misconceptions about life insurance. Now, we are quickly running out of time, and Cait's going to stay around for the next 3.5 hours answering questions, which is really generous of you, Cait. So thank you for that. But I'm just going to kind of go through some misconceptions. So people often think it's cheaper to go through the super fund to get insurance. As I said, that's a really common way that people think about it. And in reality, it's just not cheaper for a lot of people if you get a level of cover above the basic cover. So this graph I'm showing where it's Australian Super versus TAL through an advisor. Now, TAL, T-A-L, is the insurance company who offers the insurance through Australian Super. So effectively, we've got a policy with the same end insurance company. Now, the default level of cover for income protection with Australian Super is $2,900 per month of benefit, 60-day waiting period, 2-year benefit period, and it costs $113. Cheapest chips. Now, if you went to TAL through an advisor for that same kind of features and level of cover, you're paying $260 $5 per year in premiums. Now, if you go, hey, $2,900 per month only for 2 years isn't enough for me. I want $5,000 a month. I want a 30-day waiting period, and I want to be paid till age 65 if I can't work again. Through Australian Super, it's going to be $2,000 a year in premiums. But through TAO, again, the same insurance company, the same end insurer, the same person paying you the check, through an advisor, it's $776. So yes, it's cheaper to go through your super fund if you just have the default cover and you're happy with that default cover. But when you increase it, often it can be more expensive, even with the same insurance company. So you can see, I mean, I know we're going to be recorded for this, but basically Australian Super and TAO gouge people if you go and increase with the super fund. When TAO, you can see the increase in cover is, kind of proportionate to the increase in cost. Now, CBUS and TAO. So again, I'm using TAO as the example only because they're they're the biggest insurance company in Australia, and they insure with CBUS as well. So again, the default cover with CBUS, $200,000 of life, 156 of TBD. For default cover, it's actually more expensive than going to TAO directly for the same occupation. Versus if you go and increase it again, CBUS is really expensive. You're paying $3,830 for $1 million of life and TBD, versus going to TAO through an advisor for $987. So again, going through an advisor, and we get paid, we do charge a small fee to help out, and we get paid a commission, similar to like mortgage broking. And it can often be heaps cheaper going through an advisor. And that's not always 100% of the case. And I've kind of talked about the date in which we quoted it, because we need to do all that stuff for legal reasons. But it was true at that time. And look, it's still true today. Myth 2, insurance is too expensive overall. Now here, I've got some examples of like a young family, life insurance of 1.2 million, TBD of 1.2 million, trauma insurance of 150,000, and then income protection as well. So, we've got a working partner and a non-working partner. So the non-working partner isn't eligible for income protection for the policies. And you can see, how affordable or unaffordable it is. So we've got 2 cars in our household. Total value of those cars is like 12 grand or something. We pay like 2.5 grand just in insurance premiums on those cars. Like at the end of the day, if I go back to that kind of matrix, car insurance for us, replacing those cars, 12 grand a year, but we still pay a significant amount on our insurance collectively. And you can see, insurance can be funded a lot through your super. So your actual cash flow impact is fairly minimal. And this is on step premiums as well. So I'm not going to explain stepped and level, but we've got the exact same example where level premiums is there as well. So it is much more expensive today, but there's a bit of nuance with regards to that. So myth 3, I can't get insurance and save for a house at the same time. So a lot of people buying their first home, they're trying to save as much as they can. So why do I want to get insurance and add another bill? So you can get life insurance, total permanent disability, income protection. That's 100% of it is funded through your super fund, and it doesn't impact your house saving deposit. Now, keep in mind there are limitations with it. You don't get trauma, no child's cover. It's not the ideal way we would like to set it up. But having insurance can be funded a lot through your super fund, or if you just want those 3 policies, all of it can be funded through your super. Massive disclaimer: you're missing out on some features I think are really important. Does it impact borrowing power? It does. Well, it depends. The answer is basically yes. If you're paying any cost through your bank account, it will potentially impact your borrowing power. So it needs to be disclosed to the bank. They'll want to, they want your kidney and to know exactly every dollar you're spending under the sun. So they want all of it. But again, if you set it up, you can set it up so 100% of the premiums are paid through super, and then post house purchase, you can, adjust the policies to add on that trauma policy and to structure it in a way that, we're more comfortable structuring it. So that's kind of the end of those presentations. I hope this has been helpful. Now we're going to go into Q&A. As I said, Cait's really generously offering to stay around for 3.5 hours. So thank you so much, Cait.
Yeah, I really have. Yeah. I just want to say what I learned out of that. It's really hard to say the word intermediary.
Intermediary. No, I butchered it.
Yeah.
Did I butcher it when I said
yeah, that's what I learned. I mean, the rest I'm sure was really good, but intermediary. That's what
I'm
I
not
got.
even going to try.
And also the rest, but that was
I'm
the main
glad
thing.
that is all
Also,
you got
it's
out
very
of it.
important.
A
Yeah,
mother of
no,
two
like the
young
rest was,
boys. I'm
yeah.
glad that was your
Also,
takeaway.
just to clarify as well, when he said Cait, his wife, not me.
No, my
No.
Cait's spelled properly.
Different.
Just
Yeah. Okay, let's
yeah.
go with that.
All right, let's go to Q&A. So we've got some
Very
Q&As teed up already
right.
because we sent emails out before
Yeah.
the webinar and people generously came and wanted some questions answered. So we're going to touch on these. Go, Cait.
Great. So my parents, my guarantor, are they allowed to sell their house to buy another one? Yes, they can. So if your parents are guarantors and use their current house and they sell and buy another house, it can be as easy as just a security swap. So it's filling out some forms, making sure that there's still enough equity. So that's that example I gave earlier, available in the new house they're buying. Obviously very important, but it can be as simple as just doing a security swap. You don't have to do a full-on refinance.
Awesome. All right, we've got a personal insurance one. Can I afford TBD and income protection when can I get affordable? I should just read the questions properly. Can I get affordable TBD and insurance and income protection as self-employed? It's past my bedtime. I can't talk properly.
Yeah.
So the answer is yes. So being self-employed or not self-employed actually doesn't have an impact on pricing. It can have a big impact on setting up the policy and setting it up well because just like borrowing money, if anyone's borrowed money as self-employed, it's a pain in the neck. You got to provide 3 kidneys. You got to go and get
yeah, you don't even have.
So yeah, pricing is actually not that different between self-employed or employed. Okay.
Great. If I'm planning on living in my property, I'm planning on purchasing but renting out one of the rooms, will this increase my borrowing capacity? No. Most banks, the answer is no, because that is usually just a private agreement that you're going to plan to do it. If you're buying this as your owner occupied home, but you're going to go say to a bank, hey, I'm also going to make money off this and rent it out, that kind of looks like it's also an investment property. So you need to be very careful. But no, you usually, if you're going to, share some of your house or whatever, there are some banks that eventually might include that for your borrowing for something else, but usually has to be on your tax return for 1 or 2 years because it's additional income. So most of the time, no.
Yeah.
That was a good answer.
All right. My company provides free income protection insurance as part of my employment advice for this type of personal insurance. So I'm not giving you advice clearly because we gave you a general advice disclaimer. But the great thing about employment, it's free income protection. It's free insurance. How good? It's free. But when you leave that company, there are potentially restrictions on taking that policy. There are. Sometimes you can. I've got a really close friend who worked for an insurance company. They offered free income protection. They made her redundant, and then she couldn't take that policy with her because you know why? She didn't have a job. So there are some really, and that was the insurance company who did it to her, which is, bless them. So there are some downsides. Also, if you will need to set up a new policy later and you have a health issue, there's an issue. But it is good. It's just about having that conversation with the advisor and going, here's the pros and cons. How likely are you to stay there? There is a bit of nuance there.
If my partner already bought their first home, can I still claim all the first home buyer benefits? So for things like the first home buyer's grant, so for instance, if you're building somewhere, most states will do a grant of some sort. So that's physical cash. The stamp duty exemptions. So that is also the one where I said, like in Vic, if it's up to 600,000, you might not have to pay any. If you have a de facto partner that has already claimed those things, no, you cannot. And you have to make basically a legal declaration to say that I have never had a spouse or a de facto partner claim any of them. If you get found out that you're trying to do a bit of a dodgy, that can bite you, so be careful. The first home guarantee scheme, though, that 5% scheme, if you are buying on your own, so it's just you and you're the first home buyer on the loan and the title, and your partner who may already own a home is not any part of it at all, you can still borrow enough. You can still go the scheme. So the first home guarantee scheme, yes. Will you have to pay stamp duty and stuff? Yes, but at least you can go the scheme. So yes and no to both those.
Go and speak to your broker. I'd like to understand the criteria you should have when choosing insurance. So the way we think about it is it's really important to understand your health history at the very beginning. So different insurers will have different views on health history and family history as well. So, a great example is breast cancer. If your mum had breast cancer over 40 or at 42, there's only one insurer who will offer cover that doesn't have a breast cancer exclusion on it. Everyone else will say, well, family history, we'll put a breast cancer exclusion. So we would lean towards that insurance company, unless there's other reasons they won't offer you cover. There are some insurance companies who will only go up to 2 exclusions on a policy and then will decline cover if they want to put 3 exclusions on it. Therefore, that kind of knocks it out for us. So we do a lot of that work up front, picking the insurance provider, predominantly based on your health history. And then the next thing is cost and affordability, because every insurer we can adjust the levels of cover and the features and benefits based on affordability, but we can't adjust exclusions and loadings just because I asked really nicely. They've got their own rules around that. So
I think it's the same as being a broker. Like, it's the expertise that comes into it. Like, we know kind of automatically, and we're up to date with banks changing policies. It's like with you with insurance, like policies starts to just kind of
that's right. The more you work with people who specialize in the area and know it back to front and do it all day long and actually work with a lot of clients, that's you and I. So of course I'm saying this is important, but it is really important because we see hundreds of people a year, and we see their medical events and we see how it impacts people. And so we would much rather recommend an insurer that's more expensive if they're going to include certain things. But we also show you all the data and all the research to say, hey, if that breast cancer exclusion isn't that important, you don't care about it, well, we can save money and go with, insurer A, B, and C. So, Cait, I was thinking we could go to some live questions because we've got heaps there. Yeah, so are there any that you've picked that you want to read out?
I can just quickly answer some. There's some quite. So I'll answer this one first just because I saw it. So having a HECS debt, a lot of people have a HECS debt. Now, what is important to know from a borrowing point of view, we have to include the debt. But in terms of how much you've got owing, with most banks is actually irrelevant. The part we have to take into account is how much of your income goes towards that debt. And that's kind of, I guess, the repayment towards your HECS that comes into play. And obviously, if depending, if you're a high income earner, even if you only had $2,000 left of HECS debt, okay, probably paid out, but let's say it's $2,000, then the banks are going to calculate that at a really high repayment amount because you're a high earner, as opposed to if you're earning $65,000, you could have a $100,000 HECS debt. They don't really care as much about the $100K owing. They look at what the repayment is that's coming out of your income, because you have to remember it's less income towards a mortgage and it is income going elsewhere. So that's what drops your borrowing. Whether you should pay your HECS off, all of those things, if it's an option, it might not even be an option, is something you should always speak to a broker about.
Great. All right. I've got a question from Sean. When looking at insurance or retail insurance, how much should the perceived customer service of a company play into a decision? So it's really interesting when it comes to insurance. If you look at the review websites, like productreview.com.au, I think it's called, every insurance company has horrible ratings because guess what? When you rate an insurance company is when you get declined to claim. So they have all got horrendous ratings. So as an advisor, we set up hundreds of policies a year. We consider it a bit, but it is interesting because we know we're going to place a policy and we like keeping the insurance with that policy because of health history and health events can happen in the future. So we know we may deal with a claim in 15 years time for that client. So the customer service, I don't get grumpy with any insurer today and go, oh, we're not going to work with them. There are some times where we've considered going, maybe we don't place clients with this insurer today because they've literally cancelled clients' policies on them and haven't reinstated them because of their IT systems. And there's only one in the market today that has done that. But so that's the only big concern if they cancel policies. But like customer service, it's really tricky because we may claim in 20 years' time and the whole management team is going to be completely different then.
Good answer. This one is a quick one. So any potential problems with a couple with one Oz and one Kiwi? You are, for the scheme, so that's the first home guarantee scheme, unfortunately not eligible. However, you can still buy. So there's still plenty of banks that will lend just because one of you is Kiwi and the other one is Australian. So yes, you might have to cop at LMI depending on your deposit size, things like that. But no, and you might still be able to claim like the stamp duty exemptions and everything. So no, not necessarily. It just might not be eligible for as many schemes.
Also, I know we're 8 minutes over time, so if you do need to go, don't feel bad. It is recorded. You can watch it later. And I will ask for people to give us feedback on this. Well, I've had feedback before that, hey, you said it was going to finish, so why did you go over time? So apologies. And we also get feedback, oh, you didn't answer my question. So, I mean, apologies to everyone. So Emily's got a really good question. So it might be a silly question, but for retail cover, when you say that the insurance policy can be paired with a super fund to pay premium, is that only for self-managed super funds? I'd imagine it's not for normal super funds or APRA funds, as they offer their own insurance. Great question. And that's when I was talking about with when advisors can set up the policy, they can set up with whatever insurance company we think is appropriate, and your current super fund can pay the premiums. And that can be any super fund. Pretty much every super fund in Australia today can do that. And how it works, and I'll geek out a little bit here, so excuse me, but they technically, the insurance company set up a super fund for you. It's super fund with quotes, and it's just there so they can take money from your super fund, obviously with your sign off and you're happy with it. But your super fund does a rollover to their super fund, and then they pay the premiums. And then there's zero balance in that super fund until next year. So yeah, it can be any insurance company with any super fund. So, and that's a lot of what we do, because we don't give super advice. At the end of the day, you can make an informed decision on where you want your super for the next 20 years. You can change 20 times over the next 20 years, but we want to keep that insurance policy where it is. So you can have your insurance with whatever provider and move to 20 different super funds over time, and you just sign a new form every time you move.
Beautiful. Also, we do a lot of SMS lending, if there are people in here that have self-managed super funds. I can't see it, but I saw somewhere, if we're in Victoria, can you still use us even if you're in a different state? Yes, we help Australia-wide, so you definitely don't have to be here. We help even clients that might live 5 minutes away. Everyone chooses Zoom these days, so I thought I did see it somewhere, but I couldn't see it.
I've got a question. Serious Victoria for a hot second. I don't believe you. But Victoria asked, can we talk about the importance of updating your insurance policies once you purchase your first home? Yeah, it's super important. So if you're setting up insurance just before you buy, what we do, we try and forward plan for that future debt. So we're not setting it up and then updating it, 6 months later. But if you set up your insurances, 3 years ago, it was right for that point in time, and then now you've bought your first home, that's a great opportunity after you've gone through the headache of buying your first home and settling and moving in and buying furniture and doing all the craziness of that. 3 months later, reach out to your advisor and ask, what needs to be updated, because almost certainly that what you did before you purchased your first home may not be adequate now that you've got your new home.
Great answer. Can casual employment in conjunction with study impact borrowing capacity when buying as a couple? It doesn't really matter if you're part-time, full-time, self-employed, casual. Borrowing is based on what you're earning. So it's based on what you're earning, any debts you've got, what your living expenses are, things like that. Casual employment, though, as a general of thumb, you have to be employed in that role for a minimum of 6 months. But outside of that, we still look at how much you're earning, just like we'd look at how much someone that's part-time is earning or full-time. So I wouldn't worry about it necessarily impacting borrowing. Obviously, if you're not working much because you're studying, then yes, if you're not earning as much, that might bring down borrowing. But if you're purchasing as a couple, depending on what the other income is, that might also help with borrowing.
And there was a question just earlier, I did see it and I can't flag it, but it's just about first home super savings scheme. So I don't know if you want to touch on that, Cait, at all, because that it's a little bit difficult when we talk about superannuation as a broker, because you can't advise on that. Do you want me to touch on that briefly?
I don't mind.
Yeah, so basically, first home super savings scheme means that you can put money into super, and then when you're ready to purchase, you can pull that money out to use it towards the deposit. It's just a tax-effective way of saving money. Definitely speak to a financial advisor if you're thinking about it, and the pros and cons and whether it's worthwhile doing. But it is another kind of incentive the government's doing to to do it, because there's a whole bunch of rules, and it's on the ATO website, so you can read about it, but definitely speak about it.
Yeah, it is. Yeah, First Home Super Saver Scheme. Make sure if you're making contributions to super that you don't get it confused with just making normal contributions to super. You can't take that out. It has to be specifically set up through this scheme, but is also another one. So we will touch on that.
I've got another question. If I'm not a resident or a citizen, can I get income protection? That's a great question, and the answer is basically yes. There's only one insurer, and it depends on your visa. Or if you're a permanent resident, really easy. If you are a visa holder, some insurers may not offer cover, but a lot do. So definitely, reach out to an advisor basically and ask them for help.
Very good. Yes, the 5% deposit scheme is a minimum of 5% all the way up to 20%. So you can do 19.9% if you want with some banks, but it doesn't have to be a minimum of 5%. So more might be still best for your situation.
All right, if there's something, Alyssa, I think. Yeah, Alyssa, if there's something that I've had before years ago, for example, a surgery years ago, does it mean I automatically won't get covered for the rest of my life? Or is it depends on the insurer? So it depends on the insurer and depends on the time frame. So generally speaking, if it's something like ACL surgery, that's a big concern for a lot of insurers, because that can, re-agitate in 10 years later, because I don't know, I'm not a doctor, but basically your ACL is a week after you snap it. But if it's something like, you had surgery on your pinky finger and it was 10 years ago, the likelihood of getting an exclusion on that is really low. But again, that's why as advisors, we ask a million questions up front about your health, because we want to know all of this stuff so we can pick the right insurer based on your individual health history.
Great. There's 3 guarantor questions in a row, so I'm going to smash all 3 of those. Can your parents go guarantor for multiple children if they have enough equity in the house? Depends who they currently bank with, if they bank with somebody, and then depends on who the other loans are with. So some banks only want to see maybe one other bank have a mortgage over that home. Some might be happy with 2, and so on. So that is very specific depending as well on the equity available. Does the guarantor get off the hook once you've covered that amount of equity in the mortgage repayment? So you would, if you have used your 20% of them or their property, then yes, basically once you've got enough equity or you've paid it down or whatever it is, then you would refinance or you would discharge them off your mortgage so they no longer are a part of it and we let go of them. So really important when you have a guarantor or you use that path, there is still a plan in place of how we're going to remove them. And that might be relying on, the market to increase, which then you've got to understand those risks. It might be relying on you saving money, whatever it is. You definitely can release them. That's always the plan. And is the guaranteed amount by the parents become part of the loan amount or deducted from the loan? If you are, you're banking on them to cover this 20% deposit, you are borrowing the full 100%. 20%, that's their portion, and the rest, the 80%. So you're still borrowing the full amount, hence why you still need to be able to afford it. It's not very common these days. We see a borrowing guarantor, so somebody who helps you increase your borrowing capacity that's a parent. It's usually a security guarantor, which is that example I gave, where it's more just relying on equity, so covering off a deposit. You still need to be able to afford everything.
Great. How are you with time, Cait? You feeling good?
Yeah, not too bad. Yeah, I can answer a few more.
All right.
I love it. Whoever's my first client meeting in the morning, sorry.
This is kind of a double question. Does the bank look more favourable if you have income protection or other insurances, just in case something happens and you can still service a mortgage? My understanding is no, they don't care.
No, they don't care. They'll just look to see if it's an extra expense.
Yeah, they won't look. They won't say, "Oh, fantastic, you're covered for it." But it is interesting because I talk about pre-debt with our clients. If you're pre-home and you're totally disabled and on income protection, banks are not giving you money to buy a house. So you've been saving for this first home, and then something happens and you can't ever work again. What we like to consider is we want to build in extra funds to be able to purchase that house if the worst was to happen. because no one's giving you money on income protection claim. Doesn't matter if you've been on for 5 years,
And
they're not lending you any money.
No, just to say as well, when we say the bank doesn't care, obviously it's very important to still have these insurances and everything. It just won't help you get approval just because you got
and again, just another bit of history lesson. Banks used to force people to get insurances. When banks owned insurance companies, they used to force people to get them as a sales tactic. Hey, we're not going to give you a loan until you got this income protection. The government actually got rid of that because it was kind of just forcing people to get policies they actually didn't want. So that's why they don't look favorably, and they can't ping you for it either.
Yeah, it's true. Is there any benefit to putting in a higher deposit or with any of these schemes? Look, it depends on your situation, but at the end of the day, the more deposit you contribute, the less your loan repayments, the less the interest that you need to pay, and more cash flow. So sure, if you're in a position you can obviously contribute a large deposit, great. 99% of the time, we're probably going to recommend that unless you need extra money left over because you might have future plans. You want to, travel and want to grow your portfolio, whatever it might be. And that then comes into play, whether it suits or not. There's another one here I'll answer. What are some mortgage options for doctors? This is really good. So there's a lot of policies out there. So for accountants or for doctors or for vets, all different industries, a lot of different banks have what we call LMI waivers. So ignoring all the schemes I went through before, if you're a doctor, depending on what type of doctor you are, you might be able to also just do 5% deposit and have LMI waived because it's under what's called a Medico policy. So there can be more options for, depending on, the industry that you're in. If you're a chartered accountant, same thing, you might be able to get in with as small as a 10% deposit. If you're a vet, same thing. So again, we will go through that. If you have the option of a Medico policy because you have a particular job you're doing, but you also have the option of the scheme, we will weigh up what is better and why, and that is all part of our job. So
awesome. All right, so beneficiaries of a policy must live in Australia, ? What if, so basically it's a legal question, so I'm not a lawyer, so don't take what I say with any authority whatsoever. My understanding is beneficiaries, and it is a little bit confusing because they're super beneficiaries as well. If you own the policy through super, my understanding they need to be Australian, in Australia, not Australian, in Australia.
Maybe Australia.
Need to be Australia. And the money goes to Australia.
Is it possible to get a loan if you've recently moved jobs? This is very case by case. To give you an example, if you go from working in admin and you go to another place working in admin, I don't know why I thought of that, but working in admin, go to another place working in admin, it's, a part-time to part-time or full-time to full-time or whatever it is. And the break between employment is less than 30 days. There are banks that won't have a problem with that. Even if you're going to be on probation, doesn't really matter. If you were in admin, but now you're going to go be an astronaut, and again, I don't know why I thought of an astronaut, but let's say the industries are completely different. I don't know why that came to my head. Then that's where the bank might be like, haven't really got experience. We probably won't lend you for a certain amount of months. If you're casual, again, usually 6 months, unless, for instance, you're going from like Woolworths to Coles and you were casual and we can show that consistency, then again, so those things are usually case by case.
And I'm gonna hijack that question, even though it wasn't asked at all, but a lot of people think that relates to insurance. They think, if banks aren't going to give me money because I've done this, insurance companies aren't going to insure me for it. And often it can be very different. You can just start a new job and you can still get insurance, income protection, disability, and there's no issues. But if you're changing jobs and you've already got policies and you've gone from a garbage truck collector, which is expensive because of the risk, and you're an accountant and you sit in an office and the risk is really low, then the insurance company may want you to be there for a longer period of time just to prove, hey, are you actually going to stay there or are you going to go back and work on the trucks? I don't know what garbage truck collectors, what colloquial language they use, but is it working on the trucks? Yeah, let's say that.
Yeah, that's my side job.
Yeah, cool. Yeah, ask your mates.
Yeah. Yes, when someone picks your trash up next week, it's actually me. What's some Oh, Victoria's still here. Wow, it's way past her. She's probably just started cooking dinner. Do you know Victoria doesn't eat dinner till like 9:30 at night? Yeah, I hope you're just as shocked as I am. It's not okay.
Yeah. Don't know. You do you,
It's not
boo. She's just like Spanish.
okay.
Simone reckons my answer about beneficiaries was wrong. Happy to be corrected. I probably am wrong.
Oh,
One of the things when you've got insurance through a super fund, insurance trustees will have their own rules about where they'll pay out a beneficiary. So could be wrong. Super fund trustees could pay out overseas. That's why I'm not a lawyer.
is maybe Simone's a
Yeah,
lawyer.
could be.
Also, lawyers have LMI waivers. Simone, if you're a lawyer and you're listening, which I think she's still on, yes. Lawyers also have LMI waivers, which is fun. How many coffees do you guys go through a day?
That's a good question. Now, I go through 3
Phil,
generally.
Phil, tell everyone what coffee you drink.
What coffee
Be
do I
honest.
drink?
I don't know, that like
a
wanker
Magic.
coffee you said. A
Yeah.
Magic.
It's a
Yeah,
Melbourne
I still
wanker coffee
confused.
order.
Yeah, let's go with that. All right. I am really sorry, but
I've got a question. So Sean, is Key Man Insurance that needs regular reviews and therefore possible fees and approval underwriting process worth a hassle for both the client and the advisor? Sean, it's getting the sense you're an advisor as well, maybe. But I mean, basically, I'll touch on this. Is reviewing insurance full stop for anyone worth the hassle of reviewing it? The answer is yes. If you're underinsured or overinsured, bringing the level of cover down is really easy. But if you need more cover, yes, you've got to go through a full application process again. So it is similar to like borrowing money. If you want to increase your home loan by $1,000, you got to prove to the bank that you can borrow the full amount, not just that extra $1,000. It's the same with insurance. If you want to increase your cover by $100,000 worth of cover, you've got to go through an underwriting process again. So my view is it is worth it, making sure that you're adequately covered. Now, if you need to increase your cover by $5,000, then settle down. Maybe it's not worth your time. That's generally my view. Is it can be too much time for the clients.
Very good. If you look, I'm going to answer this question because I like Zoe. If you use equity in an existing home to buy an investment property, do you need 20% deposit? No, you don't. So same rule. If you do want to buy an investment property, you can technically still purchase with less than a 20% deposit, just like if you're buying an owner-occupied home. But same thing, you're going to cop lender's mortgage insurance. Most banks might want you to come up with a bit of a larger deposit, so not 5%, but more likely that 10 to 12, 13% to be a bit random, because we still have to allow for lender's mortgage insurance. So that's something we can weigh up. We have plenty of clients that really want to buy an investment. They feel it's worth it. The rental return, they're going to cop some LMI because they haven't quite got 20%, but that really suits them. There's others that want to wait for that 20%.
All right, I think we start wrapping out. I got one more question. Sean, I'm not going to answer your question because it's a little bit like too much about why we at our business have chosen to do it. And you're a power client, reach out to me on LinkedIn, happy to have a chat and answer your question anytime. But I'm going to answer Molly's question about, are there any personal insurances that cover redundancies? It's a really good question. So there are some covers, like the only insurer who used to cover redundancies was like Virgin Insurance. And last time I looked, it's pretty unusual. And those policies, they've got to renew it every year. The insurance company can just actually cancel that policy every renewal, so they don't have to abide by their contract. If you paid your premiums for that year, they do, but then they can just scrap that policy. There are some older policies where banks used to own insurance companies where you had income protection that had some features where they would pay your mortgage on a redundancy. They're no longer around these days. But if you've got an old policy and you're redundant, reach out to your advisor who helped you set it up and just say, hey, is there anything we can do? But generally speaking, short answer, no.
I'm going to answer one more because I just saw Sally's and she's still on, which is very sweet. Is pros and cons to refinancing in one person's name to couple's name, title still in the one person? This is very personal depending on your situation. So the risk, and look, it's the same with, I guess, talking about insurances. It's always the topics that are a bit hard to have the conversation on, but are really important to have. Things like weighing up, okay, if you've just added, your partner onto the loan, even though they're not onto the title, and you do separate, what do you have in play that is going to protect both of you, one of you, whatever it is, because you need to make sure of this. So some clients really want to get a financial agreement in place, and some clients, they don't care. They're literally like, nah, like we're fine. We're going to add them onto the loan. Doesn't bother us. We've got our own private agreement. We recommend obviously getting that financial agreement, but it really depends on them. The pros, it's obviously going to help with your potentially borrowing capacity. So sometimes there might be situations where a client has to add the partner onto the loan because they're now de facto, so their borrowing's dropped or they've got kids or whatever it is, and they really want to refinance to get maybe a better rate, but they have to be able to add the partner. And there's other cases they don't need to, so they don't consider it. Obviously, if you're looking at adding them to the title, depending if it's an owner-occupied place or an investment, there might be things like having to pay stamp duty and extra fees, but the actual adding onto the loan, it might help with borrowing to be able to actually refinance. You have to weigh up in case, and it's a hard conversation to have, but if something, you were to separate and if you can then afford it on your own, things like that. But again, people do it all the time. So we see it very often when people refinance. I think that is, I hope I didn't really miss any. I think we smashed it.
I think we did pretty well. And, if anyone's got any questions, they can hit us up individually later. So feel free to get in contact with us. If you do need help getting a mortgage, even if you think you're 5 years away, as Cait said at the very beginning, jump on to Zella's website. And what do we do? You fill in a form, maybe? Is that what?
What do we do? What do we do for a job?
No, I don't know what you guys do. I know what we do.
We'll get some information off you to see how we can help you, basically, to be able to guide you.
As Cait said at the very start, like, it's better to engage brokers at the start because you may not realize that you can actually get into a home much sooner. And if you need any help with your insurance needs, or if you just want to chat with one of our advisors, got any burning questions, you can jump onto our website, skye.com.au/get-started. You can see the website. If you want to jump on there, you can book in a phone call, 15-minute phone call with one of the advisors and ask any questions you want. The other thing is, once this webinar finishes, you're going to be redirected to a survey. We love feedback, as much positive feedback as possible towards Cait's session, please.
But not good.
No, just honest. I just like honesty. It's, a circle of trust amongst us.
Yeah.
And so, we just love feedback. We really want to, we try and do this every second month in our business at Skye. We want to bring in, we do insurance. We love geeking out about insurance. So if you are interested in joining any other webinars that we do, definitely jump on. But we want to get better. We want to make sure these are adding a lot of value to everyone. So jump on, fill in the survey, and thanks everyone for watching. And amazing job, Cait. Thank you for coming and joining me. You did wonderful.
Thanks for having me. It's been a pleasure. I had got paid to say that. Also, give feedback about my Crocs. Thank you so much, everyone. Have a lovely night. I'm going to go and sleep.
Awesome. Thanks, everyone. I don't know how to finish this thing.
Neither. Great. I'm